Most people are not poor because they never worked hard. Most people are poor because they worked hard for the wrong kind of income, then mistook motion for progress. I have watched this pattern my whole life. A man wakes up early, drives through traffic, gives the best years of his life to a company, brings home a respectable paycheck, and feels proud because the world told him that is what responsible adults do. Then he looks up 20 years later and realizes something uncomfortable. His salary went up, his stress went up, his lifestyle went up, but his freedom did not go up. He was trained to earn, he was never trained to own. That is the first distinction I want you to understand, because it is the line that separates people who look successful from people who become durable. A paycheck can make you look rich. Profit is what makes you hard to break. A paycheck feeds your month. Profit changes your life. The average person lives inside a financial treadmill disguised as a career. They believe the answer to every money problem is one more raise, one more promotion, one more side gig, one more bonus, one more degree, one more certification, one more year of grinding. They are always one step away from the version of life they think will finally feel secure. But the problem is not only how much they earn, the problem is that the machine they depend on shuts off the moment they stop showing up. That is not wealth. That is rented income. And rented income is dangerous because the landlord is time, energy, health, corporate politics, economic cycles, and the mood of people you do not control. I learned a long time ago that if you want to sleep well, you need income that continues even when you are not standing at the cash register of your own labor. You need ownership. You need assets. You need claims on profits that keep moving whether you are in the room or not. That is why I have never thought like a collector of salaries. I think like a collector of cash, producing assets. The world teaches the young to chase the largest paycheck they can command. The intelligent investor asks a different question. How quickly can I convert earned income into owned income? That question changes almost everything. It changes how you think about spending. It changes how you think about taxes. It changes how you think about risk. It changes how you think about time. And most of all, it changes what you call success. I know people who make enormous salaries and are one disruption away from panic. They have a large house, a luxury car, expensive habits, and the quiet fear that all of it depends on the next quarter, the next contract, the next management reshuffle, the next good year. They are dressed like wealth and structured like fragility. Then I know people whose income from businesses, stocks, real estate, private deals, and productive assets keeps showing up regardless of whether they took a vacation that month. They may even look simpler from the outside. But simplicity with ownership is stronger than glamour without it. If you want to stop needing a paycheck, you have to stop worshiping the paycheck. You have to start building the machine that replaces it. And that machine begins with only 3 numbers, not 700 indicators, not a secret option strategy, not an algorithm, not the latest thing screaming across social media. 3 numbers. I am talking about a discipline I would summarize as 75, 15, and 10, 70. 5 is the maximum portion of each dollar you allow yourself to spend. 15 is the minimum portion of each dollar you commit to investing. 10 is the minimum portion of each dollar you commit to saving. Most people hear that and immediately say it sounds too simple. Of course it is simple. The hard part in money is almost never the formula. The hard part is whether you are willing to reorganize your life around it. The average person is not losing because the math is mysterious. The average person is losing because every dollar arrives pre-assigned to consumption. Money comes in carrying the expectations of rent, car payments, food delivery, lifestyle upgrades, small indulgences, status purchases, and the 1,000 leaks people call normal life. Then they tell themselves they will invest what is left. What is left is usually nothing. That is why most people never buy enough profit-producing assets to become free. They do not have an investing problem first. They have a capture problem. Their money never survives first contact with their lifestyle. So let me make this very plain. If you spend first and invest later, you will almost always stay a worker. If you invest first and spend what remains, you begin the transition to owner. That transition is where the real game begins. I think of this as the ownership switch. Before the switch, every raise mostly feeds your expenses. After the switch, every raise increasingly feeds your assets. Before the switch, your money disappears into things that require more money. After the switch, your money starts buying things that produce more money. That sounds obvious, but obvious things become powerful only when you enforce them. Which brings me to the next point. This system does not work in one account. It works in 3. I do not mean 3 vague mental categories. I mean 3 separate buckets with walls between them. One bucket is spending, one bucket is saving, one bucket is investing. The reason for this is not accounting elegance. it is behavioral defense. Human beings are experts at stealing from their future selves while calling it flexibility. When money sits in one place, every purchase can be rationalized. The emergency fund becomes a vacation fund, the investing fund becomes holiday shopping, the tax reserve becomes a furniture upgrade. The line between essential and optional becomes foggy the moment desire walks into the room. Segregation fixes that. A separate spending account tells you what your life is allowed to cost right now. A separate savings account protects you from interruption. A separate investing account builds the engine. Each dollar needs an assignment before emotion gets to vote. That is why automation matters more than motivation. Motivation is loud on Sunday night and weak by Wednesday afternoon. Automation does not care about your mood. The moment money arrives, it should move by instruction, not by feeling. That is how adults who build wealth operate. They do not trust discipline alone. They build systems that make discipline easier than temptation. Now, when people hear 75, 15, and 10, they usually focus on the sacrifice. I focus on the sequence. The first number, 75, is your lifestyle ceiling, not your target, your ceiling. Most people reverse that. They treat lifestyle as something that naturally expands to whatever they can finance. That is why pay raises so often create nicer versions of the same anxiety. The apartment becomes a bigger apartment. The used car becomes a luxury lease. The vacation becomes a more expensive vacation. The wardrobe gets upgraded. The subscriptions multiply. The habits become premium. The person is still running, just on a more expensive treadmill. A ceiling interrupts that drift. It says that for every dollar I earn, only 75 cents is allowed to participate in my current lifestyle. That one rule alone forces intelligence. It forces you to ask whether your spending supports your life or merely advertises it. It forces you to distinguish between comfort and vanity. It forces you to decide whether you want to impress people or outlast them. A lot of Americans would rather look rich this month than become rich this decade. That is why they will finance a vehicle that eats hundreds of dollars every month while not having enough cash to handle a very ordinary repair without stress. They want the image of progress more than the structure of progress. Image is expensive. Substance compounds. If you want financial independence, your lifestyle cannot be an open bidding war between your desires and your future. It has to be governed. The second number, 10, is your stability reserve. This is savings, but not savings as a permanent identity. I do not want you thinking of savings as a place where money retires. I want you thinking of it as a shock absorber. Its job is not to make you rich. Its job is to stop a bad month from turning into a desperate decision. If your car breaks down, if you lose your job, if the economy turns, if your health changes, if your business has a rough quarter, if a family member needs help, you need liquid breathing room. Otherwise, every challenge becomes a crisis. And when people are in crisis, they sell the wrong assets, borrow at the wrong terms, panic into the wrong decisions, and hand years of progress back to the world because they were undercapitalized for ordinary life. That is why I tell people to build somewhere between 3 and 12 months of expenses in cash or cash equivalents, depending on the complexity of their life. A 25-year-old with no children, low overhead, and flexible living arrangements does not need to structure life the same way as a 55-year-old supporting a family, holding a mortgage, carrying insurance obligations, and operating with more fixed commitments. Risk capacity is personal. But the principle is not a household. A no reserve is not bold. It is brittle. And brittle people make poor investors because they cannot stay rational long enough for compounding to do its work. Once that reserve is built, the 10 can begin migrating, the formula can evolve. Then the model stops being 75-15. 10 and begins to look more like 75-25. That is where acceleration starts. That is when the machine begins to feel alive. But before we get to that machine, I want to stay on the third number because this is where almost every financial life is won or lost. The 15 is not just money set aside. The 15 is your freedom purchase. This is the money that buys your claim on future profit. This is the money that lets you stop being merely an employee of your own effort and start becoming an owner of productive systems. And there are really only 3 broad ways to do that. You can build the machine, you can join a machine that shares profit with you, or you can buy pieces of machines other people already built. The first path is entrepreneurship. Build a business, survive the hard years, create something useful, manage expenses, generate margins, and own the residual profit after costs are paid. This path can create extraordinary wealth, but it demands temperament, endurance, adaptability, and a tolerance for uncertainty that many people romanticize and few people truly possess. A business is not freedom in the beginning. It is concentrated responsibility. You do not own a business in the early years. The business owns your calendar, your attention, your emotions, and often your sleep. For the right person, that trade is worthwhile. For the wrong person, it is misery dressed as ambition. That is why I never tell everybody to start a business. I tell them to understand ownership and then choose the form of ownership that matches their temperament. The second path is to work inside a machine that shares profit. Some companies do this through stock grants, some do it through options, some do it through profit sharing bonuses, some do it through meaningful internal ownership structures. This path can be attractive because it lets you combine earned income and economic participation in a growing enterprise. A person who joins the right company early and receives a real stake in the upside can compress decades of ordinary wealth building into a much shorter period. But let us be honest, most people do not work for companies like that. And many who think they do are holding compensation that sounds like ownership but behaves like dependency. So for the average person, the third path matters most. Buy your way into profits. That is investing. That is what investing is at its core. You are taking cash produced by your labor and using it to acquire claims on the labor assets and profits of others. That shift matters because your money can work without fatigue. Your money does not need weekends. Your money does not ask for sick leave. Your money does not get distracted. Your money does not burn out. Your money can sit inside a productive asset and keep compounding while you are asleep, traveling, reading, or dealing with life. That is why ownership scales more gracefully than effort. There is always a ceiling on what one human being can personally grind out. There is much less of a ceiling on what owned assets can produce over time. Now, the next mistake people make is assuming there is one perfect asset class and that wealth belongs only to the devotees of that one temple. One crowd says real estate is the only real path. Another says stocks are superior. Another says gold is the ultimate answer. Another says private business. Another says energy. Another says digital assets. Most of the loud people in finance are not giving you universal truth. They are often selling identity. And identity is dangerous in investing because it makes you loyal to a method when you should be loyal to results and discipline. I've always believed in going where the economics are sound and the odds are favorable. That means sometimes broad American businesses, sometimes individual equities, sometimes real estate, sometimes special situations, sometimes cash, sometimes opportunities that only appear because fear is temporarily in control. The point is not to marry a category. The point is to allocate capital intelligently. Different cycles create different bargains. Different eras reward different forms of patience. A person who bought distressed real estate after a housing collapse saw one kind of opportunity. A person who bought excellent businesses during panic years saw another. A person who bought when everyone else was dumping good assets to solve short-term discomfort saw the same truth in a different outfit. The opportunity changes costume. The principal does not own productive assets at sensible prices and let time work on your behalf. Now, for many people, the simplest place to begin buying profits is the public market. Not because it is glamorous, because it is accessible. You can begin with modest sums, you can buy broad exposure, you can automate contributions, you can avoid the fatal error of pretending you are a genius picker before you have learned to be a disciplined allocator. I would rather see a young investor consistently buying broad, low-cost exposure to productive American enterprise than chasing the fantasy of finding the next miracle stock from online noise. A broad market fund is not exciting cocktail conversation. It is often effective, and effectiveness matters more than excitement. If you buy a total market basket, you are buying a wide collection of businesses rather than making your future depend on one heroic prediction. If you buy a large cap index, you are buying the dominant engines of the economy. If you buy a more growth-heavy basket, you are accepting more volatility in exchange for the possibility of greater long-run compounding. If you buy dividend-focused vehicles, you are tilting toward businesses that not only earn but distribute cash. If you buy real estate, you may gain cash flow, tax advantages, and a hard asset you can understand with your senses, but you also accept operational complexity, financing risk, and the burden of management. If you buy into private business opportunities, you may gain access to sharper upside, but only if you know what you are doing and can evaluate incentives, operators, and risk with unusual care. None of those paths are magical. All of them can be useful. But the larger point is that you do not need to begin with complexity. You need to begin with consistency. The person who starts with one intelligent habit has a chance. The person who keeps waiting for the perfect strategy usually just stays uninvolved long enough for inflation and lifestyle to win. And that brings me to one of my favorite ideas in this entire subject. Always be buying. Not always be buying anything. Always be buying good assets through a durable process. People want a dramatic, cinematic moment to begin wealth creation. They want a special month, a crash, a tip, a signal, a guru, a once in a decade call. But most fortunes are not built by one perfect entry. They are built by repeated sensible entries over long spans of time. A standing investment habit is more powerful than a burst of temporary enthusiasm. Whether markets are optimistic or frightened, whether the headlines are calm or loud, whether rates are rising or falling, whether the president is popular or not, your process should continue. That is why scheduled investing is so powerful. You remove ego from the transaction. You stop asking whether this week feels emotionally safe. You buy because buying ownership is part of the structure of your life. When prices are high, your money buys fewer shares. When prices are lower, your money buys more shares. Over time, discipline begins to outperform drama. And then there is the companion rule, buy the dip. I do not mean blindly buying garbage because it is cheaper than it used to be. I mean understanding that market declines in quality assets are not always warnings. Very often they are invitations. The average person sees lower prices and feels danger. The practiced investor sees lower prices in strong assets and sees improved future returns. This is one of the great psychological divides in finance. The public wants proof before buying. The investor wants value before buying. By the time the news feels reassuring, a lot of the easy money has usually been made. That is why people who chase headlines so often arrive late. They are not investing, they are purchasing comfort after the market has already repriced it. That is one reason I am cautious about people treating every trending ticker as insight. Research is not the same as exposure to noise intelligence. In investing comes from understanding business quality, valuation, incentives, industry movement, balance sheet, strength, cash generation, competitive durability, and the simple but rare skill of waiting for a favorable mismatch between price and value. Without that, a lot of people are just gambling with better vocabulary. Now, at this point, someone always asks me what they should buy. That is the wrong first question. The first question is what kind of investor you are willing to become. Are you passive? Then your job is to build a broad, low-cost, automated ownership plan and stick to it for years. Are you active? Then your job is harder. You must study where capital is flowing, where economics are changing, where demand is building, where regulation is reshaping incentives, where supply is constrained, and where the market is either underestimating or overestimating the implications. Active investing can produce better outcomes. It can also produce faster self-destruction for the undisciplined. Most people think active investing means excitement. I think active investing means homework. More risk should come attached to more analysis, not more confidence. And this is where many people fail. They want active investor returns with passive investor effort. They read a few posts, watch a few clips, absorb a few headlines, and then start believing they are making informed decisions. They are not. They are outsourcing conviction to strangers and calling it insight. The market is very good at taking money from people who need action in order to feel intelligent. Sometimes the most intelligent thing you can do is keep buying a sensible basket and wait. Sometimes the most intelligent thing you can do is buy more when fear creates bargains. Sometimes the most intelligent thing you can do is sit on your hands until the odds improve. But all of this still comes back to the same truth. You must become an owner. You cannot spend every dollar and expect compounding to rescue you. You cannot consume like a celebrity and invest like a hobbyist and expect to wake up financially free. The sequence matters. Spend within a boundary, save for resilience, invest for freedom. That is why I like these three numbers so much. They are not merely budget percentages, they are the architecture of transition. The 75 keeps your lifestyle from eating your future. The 10 protects your life from interruption. The 15 buys the assets that eventually make the paycheck optional. Then as your safety reserve fills and your income grows, the machine strengthens. 15 becomes 20, then 25, then maybe more. That is how the dependence starts to weaken, not overnight, not through fantasy, through repeated capital allocation. And this is where the final lesson comes in. Time. Everybody wants to know how fast they can stop needing a paycheck. That question sounds practical, but it often hides impatience. Impatience is expensive. Wealth is not usually built in 10 days, 10 weeks, or 10 months. In most durable cases, it is built across many years of behavior that look boring to outside observers. You buy, you hold, you reinvest, you buy more, you survive declines. You do not panic, you do not keep redesigning your philosophy every time the market develops a new personality. You let time do what time has always done for people who own productive assets and refuse to be shaken out of them by noise. The public underestimates how much money can accumulate through long periods of moderate compounding. They also underestimate how badly they damage themselves by interrupting compounding with fear, lifestyle creep, and impatience. It is not unusual to see people work very hard for 20 years and still have little freedom because every good year reset their lifestyle upward rather than their ownership upward. That is a tragic waste of effort. You do not need a perfect start. You need a controlled structure. You do not need to know the one best investment for the next 40 years. You need to begin buying sensible assets and learning as you go. You do not need to become a monk. You need to stop making your future negotiate with every impulse in your present. And if you do that long enough, something interesting happens. The paycheck becomes less central. At first, it still matters a lot. Of course it does. Then it matters less because your reserve is there. Then it matters less because your portfolio begins to throw off value. Then it matters less because market declines become buying opportunities instead of personal emergencies. Then it matters less because your owned income starts to carry more of the burden. And one day you realize you no longer think like someone trying to protect a salary. You think like someone allocating capital. That is a very important shift because people who think like capital allocators are not constantly asking how to earn more this month. They are asking where the next dollar should go so it can produce more future dollars. That question builds empires, not just budgets. Now let me leave you with something more uncomfortable. If you ignore this, life will still teach you the lesson. It will just teach it more harshly. A layoff will teach you that one income stream is fragile. A health scare will teach you why liquidity matters. An economic panic will teach you whether you are an investor or merely an optimist. A market decline will teach you whether your convictions were real or borrowed. A decade of earning without owning will teach you that high income and wealth are not twins. You can learn this through design or through regret. I prefer design, so here is the contract I would urge you to make with yourself. From this point forward, every dollar that enters your life will have a job before it has a temptation. You will place a ceiling on lifestyle. You will build a reserve against shock. You will buy assets that produce profit. You will automate the process so your future is not left at the mercy of your mood. You will stop chasing hot money and start respecting long-term compounding. You will keep buying through noise, through elections, through recessions, through market declines, through euphorias, through gloomy forecasts, and through the ordinary chaos of the world, because the goal is not to look rich on the way to dinner. The goal is to become difficult to break. The goal is to build a life where your bills do not depend entirely on your next hour of labor. The goal is to reach the point where your money works harder than you do. That is when the paycheck stops being your master. That is when profit starts becoming your partner. And that is when you begin to understand what freedom actually costs. It costs structure. It costs patience. It costs saying no to some pleasures now so that time can say yes to much larger pleasures later. Most people will not do it. They will keep buying appearances. They will keep telling themselves they will invest when life settles down. They will keep asking for the next tip instead of building the next habit. And 20 years later, they will wonder why they worked so hard and still feel trapped. Do not make that trade. Make the harder trade now. Choose ownership over image. Choose process over impulse. Choose profit over dependence. Choose the three numbers and the discipline behind them. Then keep going long enough for the world to pay you for your patience. Because once you understand that wealth is built, not by chasing paychecks, but by owning streams of profit, you stop asking how to earn more hours. You start asking how to own more engines. That is the question that changes everything. And the beautiful thing is that you do not need millions to begin answering it. You just need the courage to stop spending like a spectator and start allocating like an owner. That is the threshold. Most people never cross it anyway.